Welcome to SMC Foundations. Think like institutions.
This is not a strategy series.
This is not about entries.
This playlist is designed to remove retail thinking and replace it with institutional decision logic.
This is the logical framework we will follow to rebuild your understanding of market structure. We begin by exposing the retail illusion, then defining the institutional footprint. From there, we'll examine the psychology of the trend, correct deep-seated foundational flaws, and finally, establish why this context must always come first.
So, first things first, we have to dismantle the common, superficial view of market trends. This is the foundation of most losing traders' approach.
On the left, you see the textbook retail definition: higher highs and higher lows, lower lows and lower highs. Now, this isn't technically wrong, but it is dangerously incomplete. It describes the effect, not the cause. Institutions, on the other hand, start with a different set of questions. They ask, why is the market making higher highs? Who is behind the order flow that's causing lower lows? They are reading the engine, not just looking at the paint job.
So let's shift our perspective. We will now learn to read trends not as simple chart patterns, but as the direct consequence of large-scale institutional order flow. They are footprints in the sand.
So, what is an uptrend? It is not just price going up. An uptrend is the visual evidence of persistent, aggressive institutional buying. It means that large players are willing to absorb sellers and continue to transact at increasingly higher prices. It's a deliberate campaign, not a random walk.
And a downtrend? This is the footprint of aggressive institutional selling and distribution. They have established the path of least resistance as downward. A retail trader who tries to buy the dip here is fighting against the dominant flow of capital. It's a low-probability endeavor.
Now we come to the range. For retail traders, a range often means boredom, chop, and frustration. They see market inactivity. But for an institution, a range is a critical zone of balance. This is their workshop. This is where they can quietly and patiently accumulate or distribute massive positions without alerting the rest of the market. It's a period of intense, calculated activity happening just beneath the surface.
Understanding the mechanics is one thing, but to truly align with smart money, you must understand the psychological dynamic at play. It's a battle between calculated institutional action and the emotional retail mindset.
Look closely at this table. The two columns are not separate, they are two sides of the same coin. In an uptrend, retail FOMO provides the exact exit liquidity that institutions need for their methodical distribution. In a downtrend, retail fear and capitulation create the discounted prices that institutions require for their quiet accumulation. And in a range, retail boredom and overtrading provide the noise and cover for institutions to execute their patient positioning. One feeds the other.
And these emotions manifest as predictable, account-destroying behaviors. Fear causes hesitation, or panic selling right at the lows. Greed causes you to over-leverage a good position, or worse, revenge trade after a loss. Institutions do not need to predict the future. They only need to predict that human nature, under pressure, will act predictably.
Okay, now we will systematically identify and correct the flawed beliefs that keep traders misaligned with the market's true flow. Pay close attention.
The first misconception is rooted in ego. The trend must reverse here because my analysis says so. The reality is this: a trend continues until the institutional objective is complete. Your opinion is irrelevant. The second is a classic trap. Higher highs mean I should keep buying. This is wrong. Those late-stage euphoric higher highs are often fueled by the last wave of retail FOMO. You're not getting in on a trend, you are providing the exit for the institutions who started it.
Next, the belief that ranging markets are dead. This is a fundamental misunderstanding. As we've established, ranges are the most efficient environment for smart money to operate. And finally, the most dangerous flaw of all, seeing trends as just abstract patterns on a chart. They are not patterns, they are the footprint of a real business operation, institutions managing inventory, risk, and executing large-scale orders.
This brings us to the most critical point. Everything we cover from here on in this course is built upon the foundation we are laying right now. Without this, nothing else works.
So what is your first and most critical task as a trader? Before you look at anything else, you must identify the current market state. Is the market trending, up or down, or is it in a range? Your ability to answer this question correctly is the absolute base layer of professional analysis.
The goal here is a complete mental shift.
You must discard the amateur game of pattern spotting. It's time to adopt the professional skill of behavioral reading. You are not looking for shapes. You are looking for the intent of the capital that creates those shapes.
So I'll leave you with this question to consider. Are you reading the chart, or are you learning to read the behavior of the players who are moving the chart? Your future in this business depends entirely on your answer.
This course is built to correct execution mistakes, not to entertain.
If this video removed a false belief for you, support the course. Like the video, share it with the trader who keeps buying higher highs, and subscribe.
This is SMC Foundations. Think like institutions.
We build context first. Execution comes later.